Well, first of all, I don't know why it was a surprise because he was always one of the front runners. It wasn't like he was like a dark horse. I mean, he was at least like 20, 30% probability, and there was only like 3 or 4, top choices. So, and I don't remember people questioning him when he was a top choice, saying, why is he at the top of the list? This guy is such a hawk, right? So it was only spun that way after he was nominated. And I think that was deliberate on the part of the Trump administration. I think they gave out those talking points. Well, I mean, you can't look at that volatility without looking at what preceded it. So we had a spectacular rise in gold and silver. The gold rally really took place over a more extended period of time. Really, gold broke out in early 2024 and had a slow and steady rise to 4,000. Then it kind of had a very quick move from 4,000 to above 5,500. Silver really went nowhere as gold went from 2,000 to 4,000. And then finally moved from 3,000 to 120. And in fact, the move from 80 to 120 was like a few days. So I think once silver broke out above 50, that was both a psychological and a technical overhead resistance going all the way back to the Hunt brothers in 1980. So I think once that happened, a lot of money came into silver, came into gold, and silver obviously got ahead of itself. The exchanges came in several rounds of, margin hikes. And I think some of the speculators got caught and there was, a lot of volatility. People got forced out of positions. A lot of weaker longs might have bailed out. You saw the media talking about a silver bubble, which, bubbles don't form over a matter of days or weeks. It's something that forms over a much longer period of time than that. But I think a lot of people may have been scared out of the market who recently got in. Maybe other people were motivated to take profits, hearing all of the talk of a bubble and the bubble's popped and the market's going to go down. But I think the volatility makes sense given the move that preceded it. I think it's a huge breakout in silver. I think silver prices are headed substantially higher from here. I think a lot of this volatility will ultimately, go away. And I think we'll see a far more orderly appreciation of silver, maybe something more similar to what was going on with gold up until the recent volatility. And I think the bull market in gold is going to persist. Gold is only about 10% off its highs. So, nothing like silver down 30, 40% from its highs. So it's just a normal correction in the gold bull market. But I think what happened in silver is a very rare event, but it coincides with something that was also rare, which was this massive breakout in silver. So I think it's very bullish for the metals and even more so for the miners. I think the precious metals mining companies are even cheaper. And Wall Street is still not woken up to that reality either. I don't know that I would say a normal move. I'm just saying that given the abnormal rally that we had and breaking out of such massive overhead resistance, it's not to be unexpected. It's not like, oh my God, look how much silver went down. Yes, but you can't look at that in a vacuum. You have to look at how much it went up and, right before then. And even when you're talking about, oh, silver crashed. Okay, but where did it crash from and where did it crash to? Because, if it's crashing into the $70 an ounce level, that's not a crash, other than for the people who happen to buy it at 120, which, was only one day. The vast majority of my clients who have been buying silver from me for 20 years, I started selling my clients silver under $5 an ounce. So for my clients, $70, $80 silver doesn't look like a crash. It looks like a really good price. I think it makes sense because obviously gold is under accumulation in the East and the selling has been coming from the West. And I think the East has it right. I think, China is correct that buying gold is the right thing to do and that the price is going to go higher. To the extent there are speculators in the U.S. that don't get this and that want to short gold and silver or who want to sell the gold and silver they have because they think it's some kind of a bubble, I think they've got it wrong. And I think the buyers have a lot more dollars that they need to convert into gold and silver than the speculators can short as far as their ability to short and sell gold and silver that they don't own and have no ability to deliver. Well, it's both because, there's a constraint on how much silver can come out of a mine. There's only so much the mines can produce. They just can't turn on a new mine just because silver is higher in price. They just can't say, oh, let's mine more silver. Most of these miners were already mining as much silver as they could at the older prices, but also has to do with the refiners. If they run out of inventory, they can't magically transfer bullion into coins and bars, the raw silver. So if all of a sudden there's a big increase in demand by investors, they just don't have the capacity to immediately supply it all. So you get a backlog and you get delays. Then obviously people will start to pay more money for a more immediate delivery of their metals. So all these things are happening. I can tell you at Schiff Gold, business was very slow for the last several years. It just picked up a lot in the last month to the point that we've never been this busy. But to go from a very slow, environment to all of a sudden busy, well, you don't have the manpower. You don't have the resources. You're not used to it. All of a sudden there's a big increase. And that's not unique to my company. Obviously, it's happening all over the industry. So, yeah, we've hired some more people. We're ramping up to deal with it. But, there's going to be problems throughout the entire distribution channel when all of a sudden there's a lot more demand for the metal.
Headlines quickly labeled the move a bubble. But true bubbles inflate over years, not days. Silver's retreat, though sharp, must be measured against the magnitude of its prior advance. A pullback from triple-digit prices toward the $70 range may feel dramatic, yet it remains historically elevated. Gold, meanwhile, declined only modestly from its highs, reinforcing the broader uptrend. Volatility in silver is not unusual, it is intrinsic to its character. Compared to gold's steadier ascent, silver often overshoots in both directions. What markets witnessed was not collapse, but recalibration after a rare technical breakout that attracted global capital in record volumes.
There's a lot of room. Wall Street has pretty much been skeptical of the gold rally ever since 2000. So the whole time gold was going up, Wall Street was expecting it to go down. In fact, if you go back to early 2024, when gold was at 2000, major banks that cover mining companies were putting seller recommendations on Newmont and Barrick. And the rationale was gold has peaked at 2000, there's no upside, and so why own these miners when all that's going to happen is the price of gold is going to go down. And so these companies have never really reassessed that bad conclusion. And so they've watched gold prices more than double since that forecast, right? And even though the gold stocks have, let's say they've tripled as gold went from 2,000 to 5,000, and that's a little bit more than the increase in the price of gold, one would have expected a lot more than that, given the magnitude that $5,000 gold has on their earnings. your earnings don't just triple when the price of gold triples. Your earnings move up by a much greater factor than that. If your cost of mining gold is $1,500 and the price is $2,000, you're making $500 an ounce. But if the cost goes to $5,000 and you're still at $1,500, right, you're making $3,500 an ounce. That's 7 times the profits on not 3 times. So there should be a lot more leverage because these companies are inherently much more valuable today. But it's not just that gold is at 5,000 today. It's that it's going to be much higher tomorrow. Wall Street still doesn't get that gold prices are going to keep rising. Not only are gold prices not going to fall, they're going to keep going up, which means the earnings that are already not being properly, attributed to these companies and valued are going to go even higher in the future. So I think you still have a great opportunity to buy these companies. And in fact, some of the best opportunities are in the juniors, the real juniors that haven't even moved as much as the senior stocks. And there, the opportunities are incredible because I think a lot of these small companies are just going to get bought out by the big companies that have massive cash flow now. What are they going to do with all their money? I mean, they could jack up their dividends a lot. They could buy back a bunch of their own stock, or they could try to accumulate more reserves so they have more gold to mine. And the easiest way to do that is buy up smaller companies that have a lot of reserves, proven, but that don't have the cash to develop them, and just buy up those reserves and just, put them on ice, or, you don't even have to develop them now. Just hold on to them because you don't have an infinite supply of gold. So, just keep them for the future because the gold's only going to get more valuable. The longer you wait to mine it, the more it's going to be worth. So some of these smaller companies may need to mine the gold now because they have obligations. But if the big companies buy them up, they don't need to mine it. They'll just throw it in there and it'll just be valued as part of their reserves. They got more operating cash flow than they know what to do with right now. They've never been making money like this. So, we've got a lot of these small companies in my gold fund, the Euro Pacific Gold Fund. EPGIX is the ticker, the no load symbol for the fund that you can get at any discount broker. And we have separately managed accounts at Euro Pacific Asset Management that focus on the mining companies. And we have other strategies, just our dividend payer strategy, for example, just owning foreign dividend payer stocks was up, I think, 62% last year. It's up about 13% this year. So crushing the U.S. stock market. But obviously, the mining focused strategies have done even better than that. But now I think it's still a great time to get into my fund because of the big position that we have, about a third of the portfolio in these really small stocks that would be hard for any other fund to buy now in that kind of size, given the type of liquidity. But I think there's some tremendous performance that we're going to get in the future based on this portfolio that people can take advantage of by buying into it now.
As you said, like gold price, for example, Q4 average gold price, I think, Nico, I got it right here. It was a $41.63 per ounce realized price in Q4. And as we just discussed ad nausea, it's like we're at close to $5,000. It's almost $1,000 higher within 6 weeks.
Yeah, and what people also don't think about is the cost side of this, because the costs have been a big problem for the mining companies until very recently. Oil is barely over $60 a barrel. That's cheap, in relationship to where it's been in the past. I mean, oil's been over 100 when gold prices were a lot lower than they are right now. So that's the main cost in mining. I mean, you've got wages, and then you've got energy. And energy is generally number one, and maybe wages number two. And the wages are not up that much given, where the dollar is right now. If you look at the Canadian dollar, the Australian dollar, some of these South American currencies, they're still relatively low compared to where they've traded against the US dollar in the past. So the operating costs are low. And another thing that people don't consider is that silver is a byproduct of mining gold. And almost all the gold mining companies mine some silver. They also may mine some platinum and other precious metals. And what the money they get from mining silver doesn't show up as earnings. It just shows up as reducing their costs. So their cost to mine gold goes down if they get more for their silver. So if they're selling their silver at $80 and they used to sell it at $30, that's a lot of money. So that lowers their costs. So you're going to see not only the top line going up, right, but the cost going down. So the margins are just exploding for these gold miners.
A significant shift underpins the rally: geographic demand. Central banks, particularly in Asia, have steadily accumulated gold reserves, reducing reliance on the U.S. dollar. While Western investors debated bubble narratives, Eastern buyers quietly expanded holdings. De-dollarization trends have accelerated amid rising fiscal deficits and political uncertainty in Washington. The U.S. national debt, now exceeding $38 trillion, continues climbing. As deficits widen and rate cut expectations grow, confidence in fiat purchasing power erodes. For many governments and institutions, gold and increasingly silver represent neutral reserve assets. The divergence is striking: steady sovereign accumulation in the East, skepticism and short-term trading in the West.
I think it's inflation, de-dollarization, which is a function of a loss of confidence in the U.S., in its ability to honestly repay its debts, in the independence of the Federal Reserve, in the Fed's commitment to maintain the dollar's value or fight inflation. I think, markets are coming to terms with the reality of, $38 trillion national debt rising, in perpetuity by 2, 3, 4, 5 trillion a year. Who knows? You've got Donald Trump wanting lower interest rates, putting pressure on the Fed to lower rates because we need lower rates, because we can't afford to pay the rates because we have so much debt. Donald Trump's main goal is to continue to inflate a bubble. He doesn't want asset prices to go down. He wants the stock market to keep going up. He wants the real estate market to keep going up. The only way to do that is by sacrificing the value of the dollar. And that's what they're doing. And so if we're sacrificing the value of the dollar, why does the world want to hold the dollars? The world doesn't want to be sacrificed. Foreign central banks don't want to hold a currency that's going to depreciate as a reserve. So foreign central banks are moving from dollars to gold. International investors are doing the same thing. And, Americans are going to be doing the same thing. It's going to be a mass exodus out of US dollars into an alternative. And gold is the most viable monetary alternative. I mean, for banks, it's really the only alternative. Private citizens, they could buy stocks, they could buy real estate, they could buy other things, but gold and silver are going to be a big part of what investors buy when they want to get rid of their dollars. And that is going to continue. There's no end in sight to the deficit spending. The Republicans have no stomach to cut government spending. They refuse to do it. They may criticize deficit spending when the Democrats do it, but the minute they have control, they do the exact same thing. Look at the big, beautiful bill that the president brags about signing. They criticize all the spending under Biden and say that's why we had inflation under Biden. Yet when they had an opportunity to cut back on the Biden spending, they not only didn't do that, they preserved all that extra spending and then added to it with extra spending of their own. And then they cut taxes. So we have less revenue than Biden had, but we have more spending. So we're going to have bigger deficits under Trump than we had under Biden. And so the world can see this, and it's like, all right, well, we got to get out. And plus we've weaponized the dollar both under Biden and Trump. We use it, to bludgeon people with sanctions. And the world doesn't like this. And now, Trump is out there chastising the world, criticizing the world. We're entitled to low rates. You guys, and you're taking advantage of us. You're ripping us off. So we're going to put tariffs on everything. We're angering a lot of our allies. And then we're, threatening to invade them. Trump was talking about invading Greenland. He eventually backed down. But the fact that he even put that out there and suggested that it was something that we were considering, I mean, why the hell does the world want to subsidize that? If we've gone from being the protector of the world to being an aggressor, to saying we can take whatever we want if we think it's in our interest to invade your country. We're just going to invade it. I don't think that's something the world wants to subsidize. And that's what they do by holding dollars.
Maybe one thing I want to follow up on and drill down just a bit more is really the Supreme Court and the tariff situation here, Peter. Just picking one of the many topics we could spend hours talking about, but just pulled up Polymarket here, and the Supreme Court rules in favor of Trump tariffs is only a 26% chance. Personally, like on this channel, we barely talked about a potential fallout of the Supreme Court ruling against the Trump tariffs, and I'm curious what your take is. What will it do to the markets, and how do we prepare for it based on what you're saying here?
Well, to the extent that the markets already expect the tariffs to be ruled unconstitutional, and they are. So, I mean, if the court rules correctly, they will get thrown out. I think the question is, how will the administration respond? How much of the tariffs will he be able to continue anyway, despite the ruling? That's hard to say. And will the court rule that the funds previously collected need to be returned? So that remains to be seen, whether they'll just say, look, you can't impose these tariffs prospectively. But I don't know if the court's going to rule that everybody who paid a tariff is entitled to their money back. Now, they should be. But I don't know if it's just going to be confined to the party that sued, and that party will get their money back, and that everybody else would have to file their own lawsuits to get their money back. I don't know. I don't know how disruptive it would be on the U.S. government to return all that money. But, I think that to the extent that the court strikes down the tariffs, and there is an economic problem that may have happened anyway, even if the tariffs were upheld, it does give the Trump administration a convenient scapegoat, because Donald Trump's narrative was the tariffs were great, the tariffs were making us rich, we had a booming economy because of the tariffs. Now, all that is a lie, but that's what Trump's been saying. Now, if the Supreme Court eliminates the tariffs, which is actually a good thing, or which actually would make the economy better, right? But let's say the Supreme Court throws out the tariffs and then the economy crashes, which it would have crashed anyway. Now Trump could say, you see, look, everything was great, and look what the court did. The court ruined this great economy that I created. So I think politically it's actually better for Trump if the Supreme Court, overrules the tariffs, because it gives him a scapegoat to blame bad stuff on that would have happened anyway. But that's happening anyway. So, at least, because Trump is going to run against, at least in the midterms, the Republicans are going to run against the Fed, and maybe they'll run against the court. They'll be able to say the Fed screwed it up by not cutting rates enough, by being too slow, and the court screwed it up by rejecting my great tariffs.
At current price levels, mining profitability transforms dramatically. When gold traded near $2,000, margins were modest. At $5,000, the earnings leverage becomes exponential. Production costs, primarily energy and labor, have not risen proportionally. Oil hovering near multi-year lows reduces operational strain. Meanwhile, silver often emerges as a byproduct of gold extraction, effectively lowering net production costs when prices rise. The result is expanding margins across the sector. Yet major banks previously issued cautious outlooks on producers like Newmont, underestimating gold's trajectory. Even after substantial gains, mining equities may still lag the underlying economics driving their profitability.
Well, first of all, I don't know why it was a surprise, because he was always one of the front runners. It wasn't like he was like a dark horse. I mean, he was at least like 20, 30% probability, and there was only like 3 or 4, top choices. So, and I don't remember people questioning him when he was a top choice, saying, why is he at the top of the list? This guy is such a hawk, right? So it was only spun that way after he was nominated. And I think that was deliberate on the part of the Trump administration. I think they gave out those talking points because that coincided with the raid on gold and silver. I mean, the big drop happened. Gold was down $500 on the day his announcement came out. And part of what was motivating the selling was that this was some kind of game changer, that he was a hawk now, and he was going to start coming in, guns a-blazing, hiking rates, shrinking, going back to quantitative tightening or some crazy stuff. And look, I think the plan of the administration is to frame this guy as if he's some kind of hawk and independent of Trump, so that when he does exactly what Trump wants and slashes interest rates, they'll be able to say, well, it must be justified because here you've got this big hawk cutting rates, so it must be okay. It must be economically justified. It's clearly not politically motivated. I didn't appoint one of my flunkies. I went and I got this totally independent guy. But I think that's all, a charade. I mean, there's no way that Trump would appoint Walsh if he thought Walsh was going to be really tough and be this hawk, because that would make him worse than Powell. And the reason he doesn't like Powell is because Powell wasn't easy enough. So he's not going to appoint somebody that will be less easy or, tight. He wants cheap money. He wants rates slashed. And if you listen to what Walsh is saying now, he's saying we need lower rates. Now, one of the things that Walsh says, which is true, is that growth doesn't cause inflation. It doesn't. And neither does low unemployment. None of that stuff causes inflation. Inflation is caused by an increase in a supply of money and credit. And what generally brings that about is deficit spending. The more deficits we have, the more money the Fed has to create to cover the cost. And so Trump is running massive deficit spending, which is ultimately going to be monetized. The Fed is already doing that. And Trump is doing what he can to expand credit, whether through it's the GSEs or the banks. And the credit expansion also fuels inflation because you have more money chasing whatever the supply of goods are. And in fact, if you look at the big, beautiful bill, it is all demand stimulus. It's no tax on tips, no tax on overtime, no tax on Social Security. None of that leads to increased investment or increased production. It just means that workers and Social Security recipients have more money to spend, to buy stuff. They don't produce anything more. They just spend more. So it's all going to be putting upward pressure on prices. But when you hear him going out and saying growth doesn't cause inflation, people think, oh, so he's outside the box because, he doesn't believe in the Phillips curve and all this nonsense, which is true. But he's also trying to pretend that we've got this booming economy and we can still cut rates because we don't have to worry about the growth causing inflation. We don't. It's not the growth that's going to cause inflation. It's the inflation. In fact, it's the inflation that's causing the growth because it's not real growth. The U.S. economy isn't really growing, right? Inflation can look like growth. And yes, there is an overinvestment right now in AI. Almost all the GDP growth comes from this AI spend. But massive amounts of debt are being accumulated to pay for all this. And we have no idea if the return on investment is going to be worth it. I don't have any doubt that AI is going to be substantial in its ability to increase productivity over time. But who knows if the investments that are being made today are really necessary to bringing that about. I don't know. A lot of the stuff that they're buying today may be obsolete in 4 or 5 years.
Physical metal markets face another dynamic, supply rigidity. Mining output cannot instantly scale with price. New projects require years of exploration, permitting, and development. Refining and minting capacity also presents bottlenecks. When investor demand surges unexpectedly, inventories deplete and delivery delays widen. Premiums rise accordingly. Industry-wide, dealers report rapid shifts from sluggish conditions to unprecedented demand spikes. Such transitions strain staffing, logistics, and fabrication networks. These are not signs of collapse. They reflect tightening availability amid renewed investor interest. Structural supply limitations combined with rising demand often create the very volatility critics misinterpret as instability.
And nobody talks about, like, what are we not doing? Where's all this money coming from? I mean, what are we not doing? Because we don't have an unlimited amount of capital. And so if we're spending all this, building out this AI infrastructure, what are we not doing? Where's the money coming from? We'll find out, like, because there's obviously a lot of things where there's been underinvestment to pay for all this.
No, it's all positive for gold. Maybe to summarize the conversation, Peter, and all the macro points that have driven gold higher have not disappeared. Yeah. They're still here. So
yeah, we know none of them. It's not like we should be spending some of that money mining gold and silver, copper, stuff like that. We need more of these mines.
I think it's just a matter of time.
We're
quite
still
honestly.
wasting money. We're still wasting money on crypto. We're still coming up with, meme coins and crap like that, because the Trump administration still wants to make America the crypto capital of the world, and he wants us to be a Bitcoin superpower or whatever. When Bitcoin is down 50% and no end in sight to where it's going, they're trying to push more money into this thing.
Well, as long as Pokemon cards still sell for record prices, like $13 million. I'm not sure if you've seen that today, but
oh no.
Then, I think Logan Paul, Jake Paul, one of the Pauls sold his Pokemon card for a new record price of $13 million. That just tells you there's too much money.
Who bought it from him?
I have no idea. I don't even care. I just know that it's too much money for something that is just like an NFT.
Yeah.
So,
but I guess I'd rather have a Pokemon card than a Bitcoin if those were my two choices.
Okay, you can hold it at least, right? So,
well, in theory, I guess that particular card is rare. Not that all Pokemon cards. There's lots of. My kid, I've got packages and packages of these Pokemon cards. So there's a huge supply of cards, but they do have limited edition cards, individual cards. I don't know what makes them much different than the other cards, because when you look at them, to me, they all look the same, right? They're not that much different. But to the collectors, they're willing to pay this crazy amount of money for, a particular card that's rare. The question is, for how much longer will people be willing to pay that much for a Pokemon card? How long are the collectors that think these cards are worth so much, how long are they going to believe that? Or even have the money to sustain the prices? Because it doesn't take much to collapse the whole market, No.
Well, we've seen it with NFTs. They're worthless now, right? They just disappeared. Like the Bored Ape or whatever it was, just...
Well, most of those, yeah. In fact, Logan Paul lost a lot of money on some of his NFTs. He had some high-profile buys where he paid a lot of money and they're worth next to nothing. So, at least he's making up for that on his Pokemon card.
Well,
although I'm not crying for the Pauls. They're making a ton, especially Jake. He's making all these fights. He's making so much money. They both live here in my neighborhood in Puerto Rico. So
there you go.
Right around the block on the same street.
Fantastic. Peter, really appreciate your time as always. A fascinating conversation. Everything points north for gold and silver here. So really appreciate it. Where do we send our audience to follow more of your work if they don't know by now, Peter?
Well, my podcast I do regularly on Schiff Radio and on my YouTube channels, both Peter Schiff and Schiff Gold. So subscribe to those channels. Follow me on X. I'm constantly posting my thoughts, especially debunking a lot of the false narratives out there perpetuated by the Trump administration now, but also by the Democrats. The Republicans think Democrats, are both lying to Americans about pretty much everything. So I try to get the truth out there, not only about economics, but about the markets, about, where you should be investing your money. And for that, you should work with me at Europe Pacific Asset Management, set up an account, talk to our advisors about having a portfolio transferred over for us to manage. Go to Schiff Gold. We've got great prices on gold and silver, particularly silver now. When I look at a lot of my major competitors, we're a lot cheaper now than we used to be because they've, really jacked up their prices more than we have. And so, you got to get some physical gold and silver. You can do that right now at schiffgold.com. And if you're a do-it-yourselfer, I've got 5 mutual funds that I manage from Europe Pacific Asset Management. You can get information on all the funds, the prospectuses, the ticker symbols on the website, and you can buy them no load if you get the advisor class through Schwab or Fidelity or any of the big online discount brokers, and just get my strategies into your portfolio, including the gold one I mentioned, EPGIX, and I mentioned the dividend payer strategy, that's EPDIX, which invests in these foreign dividend paying stocks. I have an emerging market fund, got a foreign bond fund. I've got a lot of funds that are specifically designed to do well in the environment that we have right now. De-dollarization, stagflation, foreign markets outperforming the U.S. market, money moving out of U.S. assets into foreign assets. You know, all of my portfolios are constructed to take advantage of this shift. And I think it's still early. I think it's got a long way to go, the trend.
Absolutely. I'm right there with you, and we'll enjoy it together. Peter, can't wait to see you again in person. Really appreciate your time. Thanks so much for coming on Soar Financially. Always a pleasure, and I'll see you again soon. Everybody else, thanks so much for tuning in. Tremendous conversation here with Peter Schiff. Always very great entertainment, but also so valuable in terms of information that he shares with us. Hope you enjoyed this conversation. Hit that like and subscribe button. Helps us out tremendously, as I mentioned before. Our goal is to reach 100,000 subscribers by the end of this quarter. Let's see if we can make it happen with your support. So thanks so much for tuning in. We'll be back with lots more. Take care out there.
The broader macroeconomic backdrop remains pivotal. Political pressure for lower interest rates continues, while fiscal expansion shows little sign of restraint. Whether tariffs survive judicial scrutiny or monetary leadership changes direction, the central challenge persists, sustaining growth amid mounting debt. Inflationary pressures, fueled by credit expansion and deficit spending, remain embedded in the system. In such an environment, hard assets gain strategic appeal. Gold's bull market appears intact. Silver's volatility may prove transitional. Together, they reflect deeper structural shifts, currency skepticism, global realignment, and resource scarcity. The question is no longer whether precious metals matter, but how central they become in the next cycle.